Friday, the government shut down Silicon Valley Bank in California, the 16th largest bank in the country. Sunday, another regional bank failed, Signature Bank in New York. They are the biggest banks to fail since Washington Mutual went down in 2008, a time when most Americans saw their 401ks decline somewhere around 40%. And it's raising the question of whether we are headed for a similar meltdown and how everyday investors should respond, if at all. The message to the country following the failures of banks in Silicon Valley and New York and huge drops in the values of other smaller banks is don't panic.
Americans can have confidence that the banking system is safe.
Everything is fine, calm.
But the lines of customers outside bank branches and today's turmoil on Wall Street suggest confidence is lacking. Colorado Springs financial advisor Brad Harvey believes Silicon Valley Bank made a bad decision when putting customers' money in low-rate investments without realizing the Federal Reserve was about to start raising rates to fight inflation.
They took money, part of their reserves, they invested it in long-term treasuries right before interest rates went up a lot. I don't think what Silicon Valley Bank was doing was super widespread, but I'm pretty sure they weren't the only ones.
In this case, though, the other large banks weren't nearly as exposed to those low-rate investments, and so there shouldn't be a widespread meltdown. Still, Harvey believes at the very least this financial shakeup will increase volatility in the market.
Today, the stock markets were very high and very low, all in the same day, over 1,200 points and changes in the Dow Jones Industrial Average. That's usually a warning sign, and in many cases it's a bad sign.
But that doesn't mean investors should suddenly withdraw from the markets entirely, because although there might not be much to celebrate immediately, Harvey believes the average 401k mutual fund with minimal exposure to the banks impacted shouldn't take a major hit.
If you're already fully invested and your time frame is 20 years from now, then this is just a blip. In the whole scheme of things, it's not going to matter. We survived 2008, and we will certainly survive this. The question is, how high is the water going to get over the next 12 to 18 months? And we just don't know the answer yet.
Harvey says if there is a market decline ahead, that will likely create some opportunities to buy stock in quality companies at a much lower price and then reap the rewards as they recover. Buy low, sell high. But again, it will likely be at least a few weeks before we can really gauge the full impact of this financial shakeup. Meanwhile, President Biden says he plans to try to strengthen regulations to keep this from happening to other banks in the future.